Same index, the HUI, the gold bugs index, relative to the S&P 500. So you see here that this high indeed was an all-time high for the HUI index in 2011. At the end of the last bull market, we hit about 0.56. It looks like in the ratio of HUI to S&P 500. So the higher this is, the more expensive gold mining stocks are relative to mainstream stocks, the S&P 500. We hit the low over here in 2001, which was when gold was about 254 or so at its 2001 February low. So this makes sense. You see here that there was a lot of volatility swinging in the gold mining index and the HUI. And look at this rally that we've been in since 2024. You could say 2025. You want to just count it over here. Right now, oh, look at this nice little thing. It's not even where we were in 2020, right? It's not even close. The rally has been huge. It's been enormous. It's been almost straight up, even straighter up than it was from 2008 to 2011. The question people are asking me now is, should I sell? Is this the top? Do mining stocks have more to climb? Is this really a rally? And my answer is no, this isn't a rally. This is a pathetic rally. It's not really a pathetic rally. It's a pathetic rally compared to other things. I'll show you those charts and why the rally in gold stocks hasn't even started yet, and how long do we have before we get to a potential top. Well, about 47 times relative to stocks. Gold mining stocks would have to climb. By stocks, I mean the S&P. 47 times relative to the S&P 500. Mining stocks would have to climb in order for there to be even close to something like a top. So no, it hasn't even started yet. There's a long way to go. You could sell a little bit if you want to lock in some dollar profits, but then again, I don't use gold mining stocks as a vehicle to accumulate dollars, and no one is going to care about dollars, and the dollar can no longer buy any amount of gold or silver. But anyway, let's answer the question. Is the gold stocks rally done? My answer?
Not even close.
Not even close.
To understand where we stand, we turn to history. The Barron's Gold Mining Index, or BGMI, tracks gold miners back over a century. Today, it shows one of the longest bullish yearly candles ever recorded, yet perspective matters. Despite this sharp rise, relative performance is still weak when measured against broader stock markets like the S&P 500. Even after years of underperformance, the index remains undervalued by historic standards. What seems like a roaring rally is in fact a faint echo of what previous bull cycles delivered. Investors should recognize we're still near the foothills, not the summit.
Oh, the first thing I want to show you is a long-term chart of the BGMI. What's the BGMI? Well, it's the oldest gold mining index that I could find on Gold Charts R Us. It stands for the Barron Gold Mining Index. BGMI goes back all the way to, I think, the 19th century, but this is what you want to see right now. This is the gold mining index of various gold stocks going back many, many decades, and you can see here we are at very near all-time highs. Look at that. Look at this rally. These are, I think, yearly candles. So yearly candle, we are in the best year nominally for gold stocks ever. I think this is the longest candle ever so far, and we're only in September, so we have a while to go. This could very well be the longest positive yearly candle ever for the Barron Gold Mining Index. So on this chart, if we just look at it nominally, it looks like, wow, the gold miners are really roaring. They're really popping. It's amazing, but no, they're not. And I will use the rest of these charts to prove it to you. Just to use a more familiar index, just to give you an idea of what I'm going to tell you here, is that look at the HUI. The HUI is the gold bugs index that is only around since, I think, 1996. Yes, this goes back as far as this index has existed. So in the middle of 1996, this index was compiled. You can see there was an all-time high here of about 640 something in 2011, right around the time when the last gold bull market ended in dollar terms. And you can see here there was a nice little triangle. I like triangles. This triangle was broken in 2024.
The HUI, or Gold Bugs Index, offers another perspective. Established in 1996, it peaked during the 2011 gold boom around 640 points. Since then, miners suffered through years of decline before bottoming out in 2016. By 2024, prices broke out of a 13-year consolidation triangle showing technical strength. But relative to the S&P 500, the index remains far below past highs. Back in 2011, gold miners were far more valuable compared to mainstream stocks. Today, even after recent gains, the sector hasn't recovered to levels seen in 2020. In relative terms, the rally hasn't even started.
It was established in 2011 to 2024. It's a 13-year triangle. You can see there's a nice little support over here going up since 2016. This was the gold mining stocks bottom over here. And you can see we broke through that triangle with a vengeance.
With a vengeance!
And we're up to about 560 or so. But is this really a rally? Nope, not even close.
Not even close. It would take over 30,000.
This is the same index, the HUI, the gold bugs index, relative to the S&P 500. So you see here that this high indeed was an all-time high for the HUI index in 2011. At the end of the last bull market, we hit about 0.56. It looks like in the ratio of HUI to S&P 500. So the higher this is, the more expensive gold mining stocks are relative to mainstream stocks, the S&P 500. We hit the low over here in 2001, which was when gold was about 254 or so at its 2001 February low. So this makes sense. You see here that there was a lot of volatility swinging in the gold mining index and the HUI. And look at this rally that we've been in since 2024. You could say 2025. You want to just count it over here. We're at now. Oh, look at this nice little thing. It's not even where we were in 2020, right? It's not even close.
Ratios between gold stocks and the S&P 500 highlight the disparity. In 1980, gold miners reached a ratio peak of 0.103, meaning they commanded significant purchasing power relative to conventional equities. Today, that figure sits closer to 0.0048, a staggering gap. For gold stocks to reach comparable highs, they'd need to rise nearly 47 times relative to the S&P 500. Whether the stock market holds steady, climbs, or falls, the reallocation of purchasing power tells the story. Gold miners remain historically cheap. The real move has not yet unfolded. Current gains are only the early tremors.
So look at this. This is the same rally relative to the S&P 500. So we see here that S&P 500 index investors would say, "Oh wow, look at your gold stocks. They're like so claiming. Oh my God, look at that huge yearly candle. It's the biggest ever." But like relative to just investing in the S&P 500 since 2015 when the gold bull market bottomed. Yeah, this hasn't been much of a bull market at all yet. Nothing, not even close.
Not even close, bud. Good. You got one more right there.
What about the BGMI? So here we see the BGMI going back to 1935, 34, something like that. And this is the ratio of the S&P 500 versus the BGMI, the Barron Gold Mining Index, to see how this ratio has been behaving since then. So we see here, the higher this goes, this is the inverse of the other chart. This is the only chart I could find of the BGMI S&P 500 ratio on gold charts R Us. I couldn't find the inverse, which is what this chart is. So these charts are flipped. So here, the lower you go, the worse the gold stocks are performing. Here, the higher you go, the worse gold stocks are performing. So we see here, they were performing very, very badly in 2001, from about 1995 to 2001. Gold mining stocks capitulated. They fell. What's the other word? Crashed. Whatever you want to say.
History shows gold miners can experience explosive moves once capital flows out of overvalued stock markets. During the late 1970s, miners crashed, then rebounded sharply, outperforming conventional equities for years. Today, conditions look eerily similar. The dollar's long-term stability is increasingly in question, government debt continues to surge, and inflationary pressures persist worldwide. These macro forces set the stage for gold miners to once again act as safe haven beneficiaries. While short-term volatility is inevitable, history suggests that when confidence in paper assets collapses, gold producers become some of the most profitable investments on the planet.
And then they went back up into 2011 over here, where the ratio was about 0.55, as we saw on the previous chart. So look at this. We see here that where we are now, we're at 4.83. Could be a little bit different right now. This is like a few days old, but you can see here we're right near the all-time lows. The all-time lows were about 7.4, 7.5, something like that. In 2015, we're not right at the lows. We're a little bit higher than the lows, yeah, but yeah, nowhere near where we were throughout the 1940s, 1950s, 1960s, 1970s, 1980s until 1994. Right, when gold stocks crashed and then rebuilt themselves and re-rallied into 2011, then crashed and have been very undervalued ever since. But the question is, what is the high? Meaning, what is the low in this chart? It's hard to see here because it's too close to the bottom, but we can calculate it with individual data points. Not here so much, but right here.
Right here. Not here or here so much. Right here.
In October 1980, and notice that the high in gold stocks was after the January 1980 spike in gold and silver. Here is a zoom in on the BGMI for 1980. This was the all-time high. It's about 1280, eyeballing it. First week of October 1980. So if you take that number, 1280 for the BGMI, the high, the all-time high in the BGMI in October 1980, 1280. Go to the next chart and you see October 1980, the first week of October 1980, we can eyeball it. It's about 132.
So should investors view today's rally as the top? Absolutely not. The data shows gold mining stocks remain undervalued on a generational scale. Risks exist, of course, such as regulatory changes, brokerage failures, or market manipulations. Yet miners also offer something unique: the potential to generate real wealth when currencies lose credibility. Unlike tech stocks or bonds, miners produce money itself in the form of gold. For investors seeking protection against systemic shocks, this sector may provide not just profits but survival. The message is clear: the rally has only just begun, and the best is yet to come.
For the S&P 500, 132 first week of October. So you take 132 divided into 1280. What do you get? You get 0.103. So we have the current number of the BGMI, which is 4.83. The all-time high in 1980 of gold stocks versus the S&P 500 was 0.103. You take 4.83 divided into 0.103 and you get 47.
47.
Right. 47.
47, which means the value of gold stocks is going to have to rise 47 times relative to the S&P 500. And you're asking me, well, is the S&P 500 going to stay the same? Is it going to rise? Is it going to fall? It doesn't make a difference. The point of this ratio is to say that the purchasing power that is currently in the S&P 500, all the dollars that it's worth, and if you were to liquidate it today and get that number that you see on your brokerage account number, dollar number, and you're able to buy all the stuff with all those dollars, all of that purchasing power will be sucked into gold mining stocks at a rate of about 47 times. So the purchasing power of the S&P 500 is going to fall 47 times, and the purchasing power of the BGMI, of the general gold stock environment portfolio, whatever, is going to rise about 47 times. So no, the rally hasn't started yet. Not even close. Are you convinced? Am I denying that there are dangers with gold mining stocks? Of course not. There are dangers with gold mining stocks. There's the big taking question, the great taking question. If you believe that brokerages are going to go down, there are ways to get around that. You can buy mutual funds directly with investors that don't go through brokerages. There are other options. Talk to more conspiratorial preppers than me. But in general, just to remind you, the reason that I invest in some gold stocks, which are not as safe as bullion, but I do invest in some gold stocks, is because in the event of an endgame where the dollar cannot purchase anything, I want companies that can pay me actual dividends in product in money terms, and gold miners can do that because they create money itself.